Hello everyone, today I'll go over the last chapter, Introduction to Options. I will talk in general about different types of derivatives, like the main focus of this lecture will be on options. Now, before I start with options, I will go over the following example. So here, let's say that there's a piece of land that's currently worth $100,000. Now you expect the price of this piece of land to increase significantly in a 1 year period. Now, for different reasons, let's say you may not have currently the $100,000 to buy this piece of land. Or let's say if you don't want to take the risk, because although you have expectation of a significant increase, you don't want to have the risk of buying and holding the land for this 1 year period. So in this case, you are considering two other alternatives of investing in this land. Now, the first alternative is that you would contact the landowner. You will offer the landowner a sum of $4,000. So mainly, as you pay this premium of $4,000, you will sign a contract with the landowner that gives you the right and not the obligation to buy the land at $100,000 during a 1 year period. So over a 1 year period, at any point in time, you may decide to buy the land. So you go to the landowner, you offer him the $100,000 and you will buy the land. Now, this is an example of a call option, which gives you the right and not the obligation to buy something at a predetermined price, in this case, the $100,000, and over a specific period of time, in this case, this 1 year period. Now, the advantages of this alternative of going into this call option contract with the landowner is that, let's say that over this 1 year period, if the price of this piece of land increases, let's say to $150,000, in this case, you will decide to exercise your right in buying the land at $100,000. And even if you don't have the amount of $100,000, it's like you directly, at the same time, you buy the land at $100,000 and you sell it at $150,000. So you will be able to make a payoff of plus $50,000. You deduct the $4,000, the premium that you've paid, you will end up with a $46,000 in net profits. Now, let's say that for a reason or another, the price of this piece of land decreases significantly to, let's say, $75,000. In this case, you don't have any obligation to buy it and to pay the $100,000, because with an option, you will only exercise your right if this exercising will result in any positive payoffs. So in this case, you will simply throw that contract away. You will throw it away because this land is worth now $75,000. So you will never pay that $100,000 to buy it. So even if you still want to buy that land, you simply get rid of the contract and you go and buy it for $75,000. So in this case, your losses are going to be mainly the $4,000 that you've paid in a premium. The second alternative would be to sign a different contract with the landowner. Based on that contract, you have the right and obligation to buy the land for a price of $100,000 over a 1 year period. In this case, you don't need to pay anything to the landowner. And here, this is an example of a forward contract, because based on a forward or a futures contract, you have the right and obligation to buy something at a predetermined price and over a predetermined period of time. Now, the disadvantage of the forward contract is that no matter what happens to the price of the land, you are committed to buying the land at $100,000. So even if the price of the land decreases to $75,000, you still have to buy it for $100,000. Now, comparing the two alternatives, as you can see, the option gives you more flexibility, because with the option, you will only buy the land when its price increases above $100,000. However, this extra flexibility, it comes at an extra cost, because with the option, you will end up paying $4,000 in premiums, while with the forward or the futures contract, you mainly don't pay anything, so there's no cost for that contract. So this was a quick example just to show you how those derivatives contracts can be used, whether the option or the forward. Now I move to the definition of derivatives contracts and the major types of those derivatives contracts. So mainly, a derivative instrument is a contract between two parties. And with this contract, you have one who will have a long position in the contract, and the other party will have a short position in that contract. Now, the reason behind the name derivatives is that the value of this contract is derived from the value of an underlying asset. Like in the previous example, the price of the land. The higher the price of the land, the higher the value of that contract that you have with the land owner. Now, the major types of derivatives contracts, we mainly have three major types: options, futures and forwards, and finally swaps. Now, an option gives the right to either buy, in this case I will be talking about a call option, or the right to sell, in this case the option is called a put option. Now, when you buy a call option and you have the right to buy, let's say you have the right to buy the land at $100,000, the other party in that contract will have an obligation to sell if you decide to buy. So if you decide to buy the land at $100,000, this means the landowner have an obligation to sell you that land at a price of $100,000. With the put option, also will have two parties, one with a long position. So the party that buys a put option and that's long the put option will have the right to sell the underlying asset at a predetermined price and over a predetermined period of time. The other party of that contract, the party with the short position, will have an obligation to buy if the party with the long position decides to sell. So this is for options. The second type, futures and forwards. So here mainly you have the right and obligation to buy the underlying asset over a predetermined period of time and at a predetermined price. Now, futures and forwards are very similar. However, there are some significant differences between the two. I will talk quickly about some of those differences. Futures contracts are mainly traded on exchanges. So they are like, let's say, if I give you an example about futures on gold. So in this case, each futures contract will give you the right and obligation to buy 100 ounces of gold. So the specifications of the contract are predetermined by the exchange. So those are exchange listed instruments. while forward contracts, they are private contracts between two parties. And those two parties, they may set in that contract any terms they want. So this is just some of the differences between futures and forwards. Finally, the third type, swaps. So swaps, a swap is a contract also between two parties where the two parties agree on exchanging a set of future cash flows. Now, the final point that relates to the definition of derivatives is that with derivatives instruments, there's no value creation. So it's mainly a zero-sum game. So let's say if the party with the long position makes a profit of $15,000, this means that the party with the short position will lose $15,000. So always the sum of the profits of long and short positions, they will sum up to zero. And this is without considering even the bid and ask spread and the transaction costs associated with derivatives trading. Now back to the slides. So now I'll start with the American call option. I will get later on to the reason why this is called American and what's the difference between an American option and a European option, which are like the two major types of options. First, American call option. So this is a contract that gives you the right to buy a certain number of shares. So here the definition is mainly for a stock option. So here the underlying asset is the stock. So mainly you have the right to buy a predetermined number of shares, which is mainly 100 shares, at a strike price. So the strike price, this is the price at which you have the right to buy the stock. We'll call it X at any time prior to maturity T. So let's see how this will work. So here I have this call option. Time T equals 0. This is capital T. This is the expiry date of the option. So with the American option, you can buy at X, which is the strike price, at any point in time from now till maturity, which is capital T. So let's say that at this point in time, this is small t, you decide at this point in time to exercise your right to buy. So in this case, you buy at X, so you will pay X and you sell the stock in the market at ST. So your payoff from exercising the option is going to be ST minus X. And you will only do that if ST is greater than X. So here exercising your right, you may exercise here, 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 or you may wait till maturity. However, if you reach maturity and the price of the stock is below the strike price, so let's say the strike price here is 100. Let's say you wait till maturity and the price at maturity as capital T is equal to $90. So in this case, if you want to exercise, you will be paying $100 for something that's worth only $90. So in this case, you will be losing $10. So in this case, you will decide not to exercise, and we say that the option will expire out of the money. So now, this call option is not an obligation to buy the 100 shares at X dollar per share, because as you've seen with that example, if the price per share is $90, you don't have the obligation to buy at 100. So you will only exercise the call, you're right, you'll only exercise the call option if the price per share is greater than the strike price. And here, of course, because this is a contract between two parties, for each long side of the contract, there's a short side. So in this case, if you have the right to buy at 100, this means that the party with the short position has the obligation to sell at $100. So here with the long call, you have the right to buy at 100. The party with the short position has an obligation to sell at 100. And as you can see, this contract is constructed in a way to benefit the party with the long position, because the party with the long position will only exercise if the stock price is above the strike price. So the party with the long position, whenever this party exercises, this means that this party will have a positive payoff, which will translate to a negative payoff for the party with the short position. For that reason, at time t equals 0, the party with the long position will pay a premium, which is the price of the call option, to the other party with the short position. While, like in the case of forwards or futures contracts, because both parties, the party with the long position and the party with the short position, one has the right and obligation to buy, the other party has the right and obligation to sell. So because both parties, they have the same obligations, in this case, there's no exchange of money. No party needs to pay the other party any amount of money at time t equals 0. Now for the American put option, so it's a contract that gives the owner the right to sell 100 shares at a strike price X at any time prior to maturity, capital T. And here, of course, as in the previous case, the party with the short position in the put will have an obligation to buy if the option is exercised. Now I move to European options. So the difference between the American and the European option is that with the American option, you have the right to exercise at any time from time t equals 0 till maturity or expiry capital T, while with the European option, you can only exercise at maturity. So if this is a European option, you cannot exercise between time t equals 0 and the expiry date, capital T. You are only able to exercise at maturity date. So let's say that you have an option that will expire on July 7th, 2020. So in this case, from now till that date, you cannot exercise the option. You are able to exercise it only on July 7th, 2020, if exercising this option will result in a positive payoff. Now, the names American and European options, this has nothing to do with the geographical location. So it's not like the case that all options in the US are American options and all options in Europe are European options. So this is mainly like the definition. An American option can be exercised at any time from now till the expiry date. A European option can only be exercised on that expiry date. Now, to answer the question, which option will be more valuable? Definitely the American option. So here, just to show you why it's the American option. So this is t equals 0. This is the expiry date. So with an American option, and this is the European. With the European option, you can only exercise at time capital T. With the American option, you can also exercise at time capital T. However, you can exercise at any point in time from t equals 0 till the expiry date of the option. So mainly, whatever you can do with the European option, you can do the same thing with the American option. However, the American option will also gives you the right to exercise between now and capital T. So for that reason, an American option will always be more valuable than a similar European option. Now, some of the notations that we're going to see. C will refer to the price of a call option. So here, C0, it's the price at time t equals 0. If this is C capital T, this means this is the price of a call option at expiry. When it's referred as C small t, this is the call price at any point in time between t equals 0 and the expiry date, capital T. P will refer to the price of a put option. X is the strike or exercise price. So this is the price at which you have the right to buy or to sell the underlying asset. Now, in some finance books, this is called K. So whether it's X or K, it means the same thing. This is the strike price, the price at which you are able to exercise your option. Capital T, the expiry date of the option. Small t, any time between the issue date, t equals 0, and the maturity date, capital T. S will refer to the stock price. And of course, here you will have S0 as capital T, the stock price at expiry, and S small t, the price of the stock at any point in time between the issue date and the maturity date. Now, before I talk about properties of options, I want to take about one of the major assumptions in arbitrage and options valuations. And this assumption is the no arbitrage assumption. And as you remember, an arbitrage opportunity is a risk-free opportunity to make some profits where you don't even need any initial investment. Because with an arbitrage opportunity, you will sell something, get the money, you will invest it in another asset, and in the future, you will always end up making a profit. So this is like a risk-free profit that requires no initial investment. Now, the no arbitrage assumption assumes that such opportunities do not exist in the market. So the no arbitrage assumption states that all assets with identical payoffs must have the same price. So this is the law of one price. Just to show you an example. So let's say that you have two assets, A and B. Let's say that the future cash flows of those two assets are exactly the same. So they are equal. In this case, the prices of A and B, they must be equal. Otherwise, there's a clear arbitrage opportunity. So even if you don't have the required money to invest, what you can do, let's say the price of A is greater than the price of B. In this case, you take a short position in A, you sell A, let's say the price of A is 105, the price of B is 100. So you sell A for 105, you keep $5 in your pocket, and you use the remaining $100 to buy B. So in this case, you ended up with an easy profit of $5, which is the difference between the two prices. Because what will happen later on, let's say at t equals 1, let's say that A and B are stocks and you have dividends paid at time t equals 1. If the two dividends are equal, you will receive the dividend from B, which is, let's say, $2, and use that same dividend to pay it for A, where you have a short position. So the future cash flows, they will all cancel out, and you will end up with that $5 profit that you've made at time t equals 0. So based on the law of one price, two assets with identical future cash flows, they should always have the same price. Also, there's no asset that has a positive payoff later and a non-negative payoff now. So if such an asset exists, we will all need to invest in that asset because you don't pay anything at time t equals 0, and in the future you keep on receiving a positive payoff. Now, properties of options. An option is said to be either in the money, out of the money, or at the money. So let's see what do we mean by those properties. Let's say that we have here a call option where you have the right to buy at X equals $100. Now, the call gives you the right to buy at X. So when you exercise the option, you can immediately buy at X and sell at ST, the stock price. So in this case, the payoff of the call is ST minus X. Now, let's say that The stock price, ST, is $110. So in this case, ST minus X is greater than 0. It's 110 minus 100. This is $10 greater than 0. So whenever you have an option with a positive payoff, if you exercise, so when the payoff is positive, when ST is greater than X, I can say that this option is in the money. Now, let's take another example or another case. Let's say that ST is equal to $85. In this case, you will definitely not exercise because ST minus X is negative. So the payoff here is negative. And mainly in this case, you will not have a negative payoff because you will simply do not exercise. In this case, we can say that the option is out of the money. Now, the last case, if ST equals 100. So in this case, ST minus X is 0 because ST equals X. The payoff is exactly 0. I can say that in this case, the option is at the money. So this is for a call option. In case I had a put option, the put option will be in the money if ST is less than X. Because remember, with the put option, you have the right to sell. So the lower the stock price, the better for you. So if you have the right to sell at 100 and the stock price is, let's say, $90, in this case, your payoff is going to be $10. So in this case, if ST is less than X, I can say that the put option is in the money. For a put option to be out of the money, this means that the stock price is high, ST is greater than X. And for a put option to be at the money, also I need to have ST equals to X. So this is here what we mean by an option that's in the money, payoff greater than 0. Out of the money, the payoff is less than 0, and at the money, the payoff is exactly 0. Now, the value of an option at any point in time is equal to two components. The first component is what we call the intrinsic value, and this is the amount that is in the money. So this is the intrinsic value plus the time value. And here the time value of an option is different than the time value of money. The time value of an option, let's say that your option will expire in a 6 months period. So even if the stock price let's say here, if you have X equals 100, currently S0 equals 99. And this is a call option. So currently this option is out of the money because its payoff is negative if you exercise it. And mainly you won't exercise it at time t equals 0. But let's say that you have 6 months till expiry. So over the 6 months period, there's enough time for the stock price to increase above $100. Now, the longer the period of time, the higher the value of the option. And here, just to give you a quick example, so let's say for option C1, called option C1, the expiry date is after 6 months. The strike price is X100. For the second option, C2, let's say that this is here, the expiry is 1 year. So in this case, the option C2 will have a higher value, a greater value relative to C1. Because whatever you can do with C1, you can do it with C2. However, with C2, you also have the right to exercise between between the 7th month till the expiry date. So in this case, options with more time till expiry, with a longer time till expiry, they will have a higher time value. As we approach the expiry date, the time value will decrease. Now, once we get to the expiry date, the time value will be equal to 0. So always, as time passes, the time value of an option will decrease. Now, later on, once I solve the extra problems that relates to options, I will show you examples of how to compute those different components, the intrinsic value and the time value of an option. Now, properties of options, the payoffs and profits. I've talked about the payoffs of a call option. I will try now to summarize these. So first, I will start with the payoff of a call option. So the payoff of a call option, if you decide to exercise, this is ST minus X, and this is only if ST is greater than, or I can say greater than or equal. In case they're equal, whether you exercise or not, it's the same thing. You will end up with a payoff of 0. So I can put it either here. So this is greater than or equal. Now, if ST is less than X, you will simply decide not to exercise. So those are the only two ways. Either the stock is above or at the strike price. In this case, you will exercise. You will end up with ST minus X. Or the stock price is below X. In this case, you will not exercise. So if I add those two together, I can say that the payoff of a call option is simply the maximum of ST minus X and 0. ST minus X, this is when you exercise, and 0 if you decide not to exercise. So the payoff of a call option is always positive, greater than or equal to 0. Now, the profit of a call option it's the maximum of ST minus X and 0 minus the call premium that you've paid at time t equals 0. Now for a put option, so now the payoff of the put option, let's say here I take ST greater than or equal to X, and this is ST less than X. With a put option, when the stock price is higher than the strike price, you will not exercise because you have the right to sell at X. Now, when the stock price is below X and the put option is in the money, you will exercise and you will be receiving X minus ST. So in this case, the payoff of the put option is the maximum of X minus ST and 0. The profit of the put the maximum of X minus ST and 0 minus P0, the premium of this put option. Now here I have the effect of different variables on options values. So here let me go back again to show you some examples. So here I have the call and here I have the put option. Let's say that for the two I have X equals 100. Here I have X equals 100. So because with the call option, your payoff is ST minus X if once it's positive. If not, you will choose 0 not to exercise. This one here is X minus ST. So now, the higher the stock price, if ST increases, ST minus X will increase. So if the stock price increases from 105 to 110, in this case, ST minus X is going to be a bigger or a higher value. So when ST increases, the call value will increase. For the put, it's X minus ST. So the higher the stock price, the lower the value of the put option. So P will decrease. Now, for any strike price X, when the strike price X increases, so the higher the strike price. With a call option, when you have a higher strike price, this means you have the right to buy at a higher price. Mainly, this is not something good for you. You prefer to buy at the lower price. So between buying at, let's say X1 is 50, X2 is 100. So you'll always prefer to buy at the lower price. The higher the strike price, the lower the value of the call option. And you can see this through looking at ST minus X. So as X increases, ST minus X is going to decrease. So here C will decrease. For the put option also, if you have X1 is 50 and X2 is 100, With the put option, you have the right to sell at the strike price X. So in this case, the higher the strike price at which you have the right to sell, the better for you. You will prefer to sell at 100 versus selling at only $50. And you can see this from here. So the higher the X, the higher the value of X minus ST. So as X increases, the put value will also increase. So this is the effect of the stock price and the strike price on the value of an option. Other variables include T, the time till maturity. As the time till maturity increases, the value of the call option will increase and the value of a put option will also increase, because over a longer period of time, you have more room to bigger fluctuations in the stock price, whether increases or decreases in the stock price. So there will be a higher time value for those options. Other variables that affect options values include the standard deviation or the variance of returns. So the higher the volatility in the stock price, the higher the expectations that the stock may move significantly up or significantly down. So this will increase the value of the option, whether it's a call or a put option. Now I go over the basic transactions in call options. So let's say that you buy an American call option at time t equals 0. Now at any point in time between time t equals 0 and capital T, the expiry date, you can do one of three things with your call option. You can either exercise your call option through paying 100 times X dollars, because remember, like for stock options, each option gives you the right to buy 100 shares. So you will be paying X dollar per share to buy each share. So then you can receive 100 shares of stock worth 100 times ST, and you can sell those shares at the price ST in the market. So the first thing you can do is to exercise the option. The other thing that you can do is to sell your option, to close your position by selling the call option for another investor at the price 100 times CT, the price of the option at that point in time. Finally, the last thing that you can do with your option is to hold the option till the expiry date. Now, the maximum loss when you invest in an option, in a call option, is the premium that you've paid at time t equals 0, because from time t equals 0 till the expiry date, you will never have a negative cash flow. If you exercise because ST is greater than X, you will be receiving a positive payoff. Or you may decide to sell the call, and also here you will be receiving a positive payoff. If you hold the call till expiry, and at expiry the stock price is below X, you will not exercise, and we can say that the option will expire out of the money. So in this case, there's no payoff after t equals 0, because you didn't exercise your option expired out of the money. So after time t equals 0, there's no negative payoff from holding an option. So your maximum loss from holding the option is mainly the premium that you've paid at time t equals 0. Now, your maximum profit, so here it's ST minus X. Let's say X equals 100. Now, let's say that this option will expire in a 1-year period. Let's say that currently the stock is selling at 95. In a 1 year period, I cannot set an upper limit on the stock price. So at expiry, this can be 150. It can even be $1,000 or $5,000. I cannot set an upper limit on the stock price. So theoretically speaking, I can say that the upside potential of a call option is unlimited, while the downside potential is limited to the premium, to the price C0 that you've paid. This is your maximum loss. Your maximum profit is unlimited. Now, the other party in that contract, the seller or the writer of the American call option, that party will have a maximum profit of C0, and the maximum loss can be unlimited for the party with the short position. Now, for the party with the short position, that party will receive the premium, will receive C0 at time t equals 0. So the seller will receive C0 as a cash flow at time t equals 0. Now, at any point in time greater than 0, like from t equals 0 till the expiry date, the writer of the option can either close out the position by buying another call option so that they can cancel out, or simply the writer can do nothing and wait and hope that the stock price won't increase above the strike price from now till the maturity or the expiry date. Now, as the maximum loss for the seller is unlimited, the seller of an option is required to have some significant amounts of money in a margin account. Now, an uncovered call position or a naked position in options refers to selling an option while not holding the underlying asset at the same time. So let's say if you sell a call option and you don't have a long position in the stock, this is called a naked or an uncovered position in the call. Also, if you take a short position in the put and you do not have a short position in the stock, this is called an uncovered put. However, between the two positions, the uncovered call, the risk of an uncovered call is much more significant. And later on, you will discover that once you start trading, it won't be that easy to take a short position in a call. So unless you have you are investing millions of dollars, your broker won't allow you to take a short position on a call. Now, buying a call option, we can call this strategy a bullish strategy. By definition, a bullish strategy is any strategy that will benefit from an increase in the value or the price of the underlying asset. So with a call option, you will benefit if the stock price increases. So I can say this is a bullish strategy, while the put is investing in a put is a bearish strategy. A bearish strategy is any strategy that will make profits if the underlying asset value decreases. Okay, now I will show you how we can construct that graph for the potential payoffs and profits or losses for a position in a call option. So let's see an example. So let's say that we have a call option with a strike price X equals $100. Now, for any price less than X, you will decide not to exercise. Let's say here also that C0 equals $5. This is the stock price. This is your payoff. And with the different color, I will have the profit. So now for any stock price below 100, you will not exercise the option. The payoff is going to be 0. So for S less than X, you will not exercise. Your payoff is equal to 0. Now, as S increases, as the stock price increases, you will exercise and you will be receiving ST minus X. So let's say if the stock price is 101, your payoff is going to be equal to $1. If this is 104, your payoff is going to be equal to $4. So for any $1 increase above 100, you will be making exactly $1 in payoff. So this line here is at a 45-degree angle. And here, as you can see, the upside potential is unlimited, because I cannot say that the stock price will not increase above $1,000 or $10,000. I cannot simply set any maximum value for the stock price. So here, this is X in our example. X is equal to 100. Now let's see the payoff, the profit of this option. We've already seen the payoff. Now, when the stock price is below X and you decide not to exercise, your profit is the maximum of ST minus X and 0. In this case, you choose 0 not to exercise. So this is the payoff minus C0. So here you will have 0 minus 5. This will be minus $5. So here I'm starting at minus 5. So for any price below X, I have a loss of $5. Now, once the stock price is equal to 100 or above 100, I will exercise. So this is the profit. However, when the price S is between 100 and 105, although I'm exercising, although I have a positive payoff, but that payoff, whether here it's $1 or here it's $4, this is not enough to offset the cost of my call option. So I will still end up losing. However, losing, like in this case here, I will lose. So here the profit is -4, so this is a loss, and in this case I have a loss of $1. The profit is equal to -1, but losing $1 or $4 is better than losing $5. So whenever you want to think about the decision to exercise or not, you do not consider the cost of the option. How much did you pay to buy that option? You only consider whether the payoff is positive or not. Because as in this case, when the stock price is between 100 and 105, so here this is 105, or this is X plus C. So at 105, you will break even. But between 100 and 105, you are minimizing your loss of $5. You are losing $1 or $2 instead of losing the full premium, the $5. Now, this point can be easily determined. So at this point, at this break-even point, I can say that here profit is equal to 0. The profit is ST minus X minus C equals 0. So here, simply ST is equal to X plus C. So when you buy the right, or you buy the call at that gives you the right to buy at $100, and the premium of that option is $5, you will need the stock price to increase above $105 in order to generate a profit. Now, this was the graph for the long call. So this is the profit for the long call. Now, let's consider the short position. Now, for a short position, as I said, this is a zero-sum game. So when the stock price is below X, the long party will not exercise. This means that the short party will have a profit, a maximum profit of $5. Once the stock price is above X, the long party will exercise. This means that now we will have a negative payoff. So if you add the two graphs together, you will get 0. So here, this is the profit or loss for the party with a short call. So this is mainly the graph for the long call. This is for a short call. Now I will go over the put option. So let's say now we have a put option. X is 50. And let's say P0 is $3. Now here for a put option, the maximum profit can be huge. However, it's limited because unlike the upper, I cannot set an upper limit on the stock price. However, I can set a lower boundary on the stock price. Because of the limited liability, the stock price cannot go below 0. So at ST equals 0, I can generate my maximum payoff and my maximum profit. Now here for the graph, I will have it directly for the profit. With the payoff, I simply do not consider the $3. So here the maximum payoff, X minus ST. So 50 minus 0 is 50. The maximum profit, this is X minus ST minus 3, the premium. So this is $47. This is my maximum profit. Now, For any price ST below X, I will exercise. My profit is X minus ST minus P0. If the stock price increases above X, do not exercise. My profit is a loss here of $3. So now if I want to draw the graph, so this is X equals 50. Here I have, this is 47. As I said here, I'm drawing the graph for the profit of the put option. So now what happens here is that this is my maximum profit. When the stock price is above 0 but still below X, I'm exercising the option. So now I need to determine this break-even point when my profit is equal to 0. So let's see how we can determine this break-even point. So profit equals 0. So I have X minus ST minus P equals 0. This means P equals X minus ST. This is the break-even point, which is also 47. Once I get to X, I will not exercise, and here my loss is minus $3. So this is the graph for the profit of a long put. For a short put, it's exactly the opposite. So let's say this is minus 47. So this is the short put. So this is the long put, an example of a long put. Okay, now I will go over some of the options strategies. Mainly I will talk about 3 different strategies: the protective put, the covered call, and the long straddle. I start first with the protective put. So a protective put, it's like you are buying an insurance on your investment. So mainly in this case, you have a long position in the stock. So mainly when you buy a stock, you expect the stock price to increase in the future. However, in order to protect yourself against any decrease in the stock price, you can buy a put option. So this put option will work as an insurance, because let's say you buy a put option that gives you the right to sell at X. So you know that whatever happens in the future, even if the stock price decreases significantly, you have the right to sell your shares at X. So this is the lowest price that you can have for your shares. And here we can see the payoff matrix for this strategy. Now for this payoff matrix, whenever you are building a payoff matrix for any strategy, start by listing each and every position, and then by listing the payoffs that you may receive based on different scenarios. Here, because you have a long put to sell at X, so I can say that I can identify two cases. The case if the stock price is below X, and the case when the stock price is above X. If the stock price is below X, I will exercise here my put option because X minus ST in this case is greater than 0. If XT is less than, if ST is greater than X, I will not exercise because the payoff is negative. X minus ST is negative. Now, the stock price at expiry will be always worth ST. So in this case, if the stock price decreases, I add my payoff from those two strategies. ST and ST, they will cancel out. So I will end up with X. If ST increases, I will have ST. So with this strategy, I was able to set a lower value for my shares. My shares, they cannot go below X. Because once the stock price goes below X, my put option will be exercised in a way to guarantee that I can get for my shares a value of X. So that's why the name of this strategy is a protective put. And here you can see what happens when I merge the long position in the stock and the long position in the put option. So now I can have a minimum value of X as here as a payoff, and this is the minimum value for my profit or loss. So I cannot lose more than a certain value when I buy this insurance or when I buy this put option. So here you can see if I buy the stock, if I'm holding the stock without having this insurance policy or this put option, if the stock price increases, I will be making a significant profit. If the stock price decreases, I may lose a lot. And if the stock price goes down to 0, I will lose my full investment. With the put option, however, as you can see, I'm giving up part of the upside potential, part of my profit, my potential profit for increases in the stock price. So here, as you can see, the profit is lower. This is because I did pay the premium for the put. However, if the stock price decreases, I'm able to limit my loss. I will not lose more than this no matter what happens to the stock price. Now, the second strategy is called a covered call. So with a covered call, you have a long position in the stock and you take a short position in the call. Now, if I'm taking a short call without having the long position in the stock, this would be an uncovered call, which is one of the riskiest investment strategies to take an uncovered call. So now what will happen with the covered call option? Here, this is the payoff of the stock, and here I have the payoff of the call option. And here, remember, this is a short position. Now, whenever I have a short position in an option and I want to compute or to determine the payoff of the strategy, I consider it as a long position and then I multiply by -1. The reason why it's better to consider it a long position because it makes things easier. because if I'm considering that it's a short position, it's hard to me to consider whether there's an exercise or not, because the exercise will happen based on like the payoff from the point of view of the party with the long position. So if it's optimal to exercise for the party with the long position, then there's going to be an exercise. The party with the short position will never decide whether the option is going to be exercised or not. Now, if the stock price is below X, the call option will not be exercised. If the stock price is above X, the party with the long position will exercise. ST minus X, this is the payoff for the party with the long position. To determine the payoff for the party with the short position, I simply multiply by -1. The stock price will always be worth ST. So here I have ST minus 0 ST. ST and ST here, they will cancel out, and I will end up with X. So here, as you can see, when I combine those two strategies, this is my profit. So here I did limit my unlimited profit from having the long position in the stock. Now, the covered call is one of the most used options strategies. One of the reasons is that, let's say, you are holding a stock, but you do not expect the stock to increase. You are holding the stock for the long term, over a 10 years period. You expect that the stock price may decrease a little bit in the upcoming 6 months, or it may remain unchanged. Let's say that the current stock price is 100. In this case, you may sell a call option with a strike price of 110 with an expiry date of 3 months or 6 months. So mainly here, you are not expecting the stock price to increase above 110 over that 3 months or 6 months period. So in this case, what will happen is that over this 6 months period, you still have the stock, and you hope to collect the premium of the call option. Let's say that the stock price increases significantly above 110. In this case, it's like you are selling your shares at the strike price X. And it's like you did place a limit sell order to sell your shares at the price X plus C. Because let's say S0 is now 100, X is 110. Initially, you hope that the option is not exercised. So you hope to be able to keep holding the shares and to collect a premium, let's say, of $5. But the worst case scenario, let's say the stock price increases above 110. So let's say S equals 111. In this case, you will be selling your shares at 110 minus 100. Let's say you did buy them initially at 100 plus 5. So you'll end up with the $15 in profits. Because mainly here, it's like you did place a limit sell order to sell your shares at 115, which is X plus C. Now for the final strategy, the long straddle. Now, a long straddle is a strategy used whenever there's an expected volatility in the stock price. So let's say we have an earnings announcement tomorrow and the expectations are mixed. So based on that announcement tomorrow, the stock price may increase significantly or decrease significantly. So here you can create a strategy called a long straddle. This strategy consists of buying a call, so long call, and long put. Both strategy, they have the same strike price, X. So mainly here, if the stock price increases significantly, you will exercise the call. If the stock price decreases significantly, you will exercise the put. Let's say here this is C0, this is P0. Now, the cost of this strategy is C plus P, the premiums. The maximum loss is also C plus P, and your maximum loss is going to be realized. So this is when the stock price remains unchanged, or the stock price ST equals X. Because in this case, whether you exercise the call or the put, the payoffs are going to be zero. In this case, you will be losing the premiums or the cost of the strategy. Now, the maximum profit here, because you have a long call, you will have unlimited profit potential. Finally, for the break-even points, here you will have two break-even points. Because if the stock price increases, you will exercise the call option. So in this case, your payoff from the call option is ST minus X minus the cost of the strategy minus C plus P. This should be equal to 0. So in this case, ST equals X plus C plus P. Now, the second break-even point is when the stock price decreases and you exercise your put option. In this case, your payoff from the put is X minus ST minus the cost C plus P. This is equal to 0. This means ST equals X minus C plus P. If I want to draw the graph of this strategy, so here this is X. At X, I will have my maximum loss, which is minus C plus P. Now, if the stock price increases, I will exercise my call option. If the stock price decreases, I will exercise my put option. Here, this is X plus C plus P. This is X minus C plus P. So you have this V shape. So here you can see for the payoff matrix, if the stock price decreases below X, my payoff is X minus ST because I will exercise the put. If the stock price increases, I will exercise the call option and my payoff is going to be ST minus X. this is the graph. You have this V shape. And here, as you can see, this is here your maximum loss. If the stock price is equal to X, your maximum profit is unlimited because of the call option. Now, that's it for the long straddle. I'll go quickly over some of the strategies without talking in the details about those strategies. So the short straddle is similar to the long straddle. This is the opposite. So if you expect that the stock price is going to remain unchanged in the upcoming period, you take a short call and a short put. So this is the opposite of the long straddle. The strip, this is if you expect that there's this announcement, let's say tomorrow, the stock price may go up significantly or down. However, if you think, if your expectations that, let's say there's 80% chance that the announcement tomorrow is going to be a bad news for the company, you expect more on the downside. In this case, you take long call. However, you take a long position in 2 put options. The strap, it's similar. However, here you put more on the call. So this is long 2 call, long 1 put. The long strangle, also this is long call at a price, at a strike price X2, and long a put at a lower strike price X1. Then here I have the spreads, the bullish spread, the bearish spread, the box spread, and the butterfly spread. So mainly those strategies, their maximum loss and maximum profit is limited. They do not expect a significant movement in the stock price. With the bullish spread, you will make money if the stock price increase, the bearish spread if the stock price decrease, and they involve buying and selling. Let's say you buy a call option and you sell another call option at a higher strike price with the bullish spread. With the bearish spread, you buy a put option and you sell another put option at a different strike price. The box spread, this is when you combine both the bullish spread and the bearish spread. And finally, the butterfly spread, you buy here, let's say long 1 call at X1, then short 2 call at X2, and finally long 1 call at X3. The payoff for this strategy is going to be something similar. The profit, something similar to this. So mainly here, your loss is limited to the cost of the strategy, and your maximum profit is also limited. You will have your maximum profit when the stock price is equal to X2. Of course, those are like some more advanced strategies. There are much more strategies. Those strategies are covered in more details in the financial derivatives course.